Welcome to this episode of Fund That Flip's Investor Insights. I'm your host, Matt Rodak, founder and CEO here at Fund That Flip. Recording today from our Cleveland office, I'm joined by John Andrews, who's our Senior Vice President of Sales and Service and is involved intimately with nearly every loan we originate and also gets to know a lot of our borrowers quite well. So welcome to the show, John.
Thank you, Matt. Glad to be here. Appreciate you having me.
Yeah, so John also joined us on episode 3. So if you're interested in learning more about John's background, be sure to check out episode 3. Also joining us is Scott Eierleman, who is a team leader on our underwriting and valuation team, and likewise has a hand in nearly all the projects we fund here. So welcome, Scott.
Thanks for having me.
Likewise, Scott was on episode 8, where we walked through some of the things on how we think about valuing our projects. So. To take a deeper dive into that, check out episode 8. All right, guys. So the topic today is a $3 million loan that we recently funded up in Edgerton, Massachusetts, which is a town up on the Cape in Mass. The loan is offering investors a 9.25% annual yield. It's underwritten to a 70% ARV, and for what it's worth, I'm personally invested in this loan, so I like this loan. So. John, to get us started, before we jump into kind of the nitty gritty on the underwriting and the valuation on this particular project, talk to us a little bit about how this deal came in, the background of the borrower, and his overall perspective on the market.
Sure, Matt. So this particular transaction came to us actually through a friend of the firm. So one of the investors on our platform had recommended to his friend, who is our borrower, that he check out Fund That Flip. He knew that his friend was kind of in the midst of a real estate project and suggested that we'd be a good firm to take a look at. So the gentleman who's our borrower is he runs a large development projects for a construction firm, development firm based out of New York City. So he's been in the construction development game for a long time, largely working on projects that range from like commercial, multifamily builds to hotels, things of that nature, and got involved in this particular Edgerton town project in Mass because it's where he vacations. So the gentleman has a history of kind of being up there in the summers for the past few decades, loves the neighborhood, and had always been trying to find a deal there. Found one, got into it, and a little slow getting through the permitting process, and as he advanced the work, realized he was kind of coming up to term on his bank loan. So he'd secured a conventional bank loan there and was advancing the project, was kind of running out of time, and he weighed his options between kind of taking this thing to completion himself with his cash and trying to get it there, but thought that might be a little slow moving. So was looking for an alternative lender that might have the appetite for funding this type of investment real estate project. His buddy recommended him to us, and we got the phone call. He told us the story. We liked his background. He answered all the questions kind of the right way in terms of what we look for from a sophistication level from our operators in terms of how they're thinking about moving through the process and how they're capitalized. And it informed us that the vast majority of the work was done. So after due diligencing the property and matching that up with the borrower's story, felt pretty good about where he sat at that given time. And at that point, we kind of lined up the numbers, and it was a good deal for us. And we were able to kind of help him in his kind of time crunch and make sure that he had the liquidity to advance the project rapidly to bring it to completion.
So a borrower that we got comfortable from an experience perspective, also I think from an income and credit perspective, I think north of 800 on the credit score. So a lot of things kind of checked off the box there. John mentioned it, and if you flip through kind of the photos on this project, this house is nearly complete, right? So Scott, talk to us a little bit, from a risk perspective. Why do we like to finance particularly new construction projects when they're, done or nearly done?
Yeah, so in this particular case, the execution risk is pretty low since it's almost done, especially since it's new construction. We like to see that. We don't expect very many surprises at this point. If something were to have gone wrong in the construction process, they've probably already gotten through it, so we like to see that. And then also, in a worst case scenario, he's already created a lot of value there, considering it's almost completed, so we feel like we could we could move it at a price point higher than we're into it for.
Gotcha. So new construction certainly comes with some additional risk. I think we like to say, like, once the property gets up, sealed in, roofs, windows, right, it kind of starts to look like a flip, right? This one is even further along than that. A lot of the flooring's down, windows, roof, painted, right? A lot of the work's already done. A little bit left to do, and that's kind of what we're helping him get through here. All right, so Scott, let's get into the numbers a little bit here. So from a loan, let's start with loan to cost, right? So from a loan to cost perspective, we're financing, it's called 76% of all costs. Talk to us a little bit about that. What does it mean? How should investors think about this? Some of our normal thresholds around loan to cost that we're looking at.
Yeah, for sure. So this particular loan, we were at about 76% loan to cost. And what does that mean? So if you take all the costs of doing the loan, and that includes the acquisition, the construction costs, and then some of the financing costs, what are we into it for at the end of the day? Our total loan amount over those costs. That's where we get our total loan to cost. How investors should think about this: for every dollar that is put into the project, Fund That Flip's going to finance about 76% of that, and the borrower is going to finance out of their own pocket about 24% of that. On any particular deal, we typically look for 80 to 85-ish% loan to cost. So in this case, we're a little bit below that. So it's something we, again, like to see.
Got it. Okay, so 76% across all costs, which is below kind of our 80% threshold. So sitting pretty good from that perspective. The other thing that kind of jumped out to me a little bit on this one that I think would be helpful talking through is specifically the loan to cost on purchase, right? So in this case, right, we've got a purchase price plus some investment made in the property already. So we're advancing about 90.5%, 90.5% of the cost, right? Meaning 90 cents of the dollars that have already been invested are going to be, that already invested in the house, like we're coming and we're leaving him with 10 cents. Earlier you said, like, normally we like to stay under 85. So talk to us a little bit about why, we're towards the higher end, if you will, of our spectrum on a loan to cost perspective at the point of, first closing the loan.
For sure. So in this case, there's a couple of reasons. Number one, if we're talking about 90% loan to cost on a $100,000 loan, we're talking about borrowers only got about 10 grand in the deal at the time of closing. Not typically something we like to see. Whereas in this case, it's a $3 million loan, 90% loan to cost at close. They still have about 300 grand. So significant amount of dollars in the deal from the borrower's side. That's where we got a level of comfort on this one. Additionally, we did get an as appraisal on this, came back at about $3.7 million. We think that makes a lot of sense given the stage that this property is in the construction process. So borrower's got 300 grand, and then there's also additional equity above that of about 700K. So that's kind of the reason why we stretched a little bit on what we we do most of the time, but we still feel like we're protected there.
Yep. So I think this is like a super important distinction to like point out a little bit. Like the ratios, LTVs, LTCs, a lot of these other things matter a lot, and they're a very good indicator, but they're different dependent on the size of the deal, right? So loan to cost and loan to value matter a lot, right? And like what we like to say is costs about the same to foreclose on a $3 million property as it does a $150,000 property. But that cost eats differently right into the amount of equity. So a little bit higher on the LTV and or LTC perspective, but on a real dollars basis, we have a lot of cushion there to absorb, any kind of downside that may result as these projects, as we all know, do have some risk that come along with them. I think that's another thing that is worth pointing out from a loan to as is perspective, right? We're at just under 3 million on a 3.7. So
under 80%,
under
77.
Yeah. So another way to think about equity there, right, is closer to, call it 77% from a true value of the property, if you will, if we had to get rid of it with no additional work going into it. So cool. So let's move on then to valuation, right? So we developed a 4.33 mil Val, again, putting us about 70% of ARV. The appraisal came back at 4.4, so pretty darn close. When we pulled comps, what do we find up there? Are we seeing, it's a pricey house for a lot of places in the country. Or is this a pretty normal sized house? What else are we seeing selling, in this part of the Cape?
Yeah, so this particular property, it's actually in the historic district in Edgartown, which is, like Matt said, up in Martha's Vineyard. So we try to keep the comp set pretty close. We kept them within about 0.3 miles of the subject property. So whenever we're within a 0.5 miles with our whole entire comp set, we feel really good there. Also, 2 data points that we pulled in were also newer constructions built in the last 3 years. And those actually traded at higher values than we have it at. Obviously, there's some different things that affect the value there, like size of the property. But at the end of the day, our range of price per square foot was about $1,230 to all the way up to $1,600. So when we're at $1,443 per square foot on our subject property, we're kind of at a happy medium there. We feel like there's some upside, and even on the downside, we feel like our property's newer, and it's going to demand a premium for that.
Yep. We typically see, right, new construction fetch a little bit of a premium over even newly renovated houses. People pay more for new because it's new.
Yeah.
Right. Okay. So interesting. So only 0.3 mile radius. We found 4 or 5 comps. And when we're looking for comps, right, we're looking for similar square footage, similar beds, similar baths, kind of similar years of how long ago they were constructed, similar lot size, proximity to. In this case, right, like the beach.
Yeah.
So, was there any other things that you think jumped out here in terms of pros and or cons relative to some of the other comps we looked at?
The other nice thing about this valuation in the comp set is that sometimes, especially when you get at this end of the market, at this high end, you see a lot of variance in the size of the properties. All 4 of our comparable properties that we used in our analysis were within, I'm trying to do the quick math here, but it's probably close to 100 or 150 square feet in total square footage. So
on for a house as big, yeah.
And then, like I said, we had 2 properties that were newer construction, one that was a little bit older, built in the early 2000s, and then one that's probably got more of a historical aspect to it because it's so old. Still thought it was a good data point from a size and quality of finishes perspective.
Got it. So we feel pretty good about our comp set on a square foot basis, on a location basis, on a kind of a relatively when it was constructed basis, which isn't always the case when you're dealing with especially higher end property. So that's something to lean into a little bit as well. And then we took kind of a down the middle approach on a $1 per square foot basis, which makes a lot of sense. All right. So LTC, LTV, those are the numbers on the deal. John, obviously, we also care a lot about getting paid back, right? So
yes, we do.
Talk to us a little bit about the exit strategy here. We wrote this, I believe, as a 6-month loan. So we've got about 5 months left on it. What's the plan to have this particular loan repaid?
Yeah, so Matt, when the borrower came to us, he had already started down the path of looking for longer term financing to hold this property as a rental. So he's kind of in process there, and he feels like there's a strong play to be had in terms of getting the appropriate long-term debt on this and holding that property and renting it, especially during peak vacation season, but even to some extent in the off season. At the same time, recognizes that we might have an opportunity here over the next month or two, just timing. Seasonally and in the market, that he might be able to realize a nice price point on the outsell here as he brings the property to completion. So he is going to list the property, and if the number makes sense, he'll take that offer and move forward. But we have a great deal of confidence based on everything that we do diligence and conversations with the borrower that whether he sells it or not, the bank takeout is there for him to hold this and execute on it as a rental property. And again, he himself kind of spends a great deal of time in the area vacationing there and has a really good feel for the market knows the local leasing agents and the brokers, and kind of has a feel for what that rental income could be, and is pretty far down the road with the bank in terms of getting that longer term debt put on that. Should he not get a juicy offer here in the coming weeks.
Got it. So primary strategy is refi, hold as an investment property.
That's correct.
Him and his family are familiar and up there, I think, almost every summer as is, for an extended period of time, which is nice. And if someone comes with an offer, like everything else, everything's for sale always, right? So
the right price, everything's for sale.
Right. So, all right, cool. So there you have it. Thank you guys. Thank you, John and Scott. Just to summarize, we've got a strong borrower with good experience, good credit. We got good equity in the project. We're on the higher end of the spectrum from an LTC and LTV perspective. We feel these risks are compensated by the fact that, one, the project is nearly complete, right? So execution risk is mitigated quite a bit. We have a value of $3.7 million of the project in its current state on a $3 million loan, right? So from where we sit in the capital stack, we feel in a pretty good position. And then we got a short duration loan, right? So 6-month term, which we also like short terms because it allows us to keep things tight, with 2 pretty strong exit options, one including we got the pre-approval on the bank financing. We got a borrower with strong income, strong credit that should have an ability to get that refinancing. And we also have got a value in a property that if we need to sell it at 4.3, 4.4, we're at appraised. We feel like that's marketable as well, right? Cool. So thank you guys again. Check out the deal if you're listening at fundthatflip.com/deals. Otherwise, hopefully you found this useful. Also shoot us an email if you've got any ideas or any other topics you'd like us to cover at investorrelations@fundthatflip.com. Otherwise, appreciate you listening to Investor Insights. This is Matt Rodak signing off.